Hi friends, so let's now move to the next chapter, which is on risk management. So here first again, I'll give a broad overview of the chapter. Risk management, what we are going to learn as part of theory segment is first understand what are the various risks a business is going to face, or in fact understand what do you mean by the term risk, and then understand what are the various risks a business is going to face. How do you identify that such a risk exists for a company, and what are the ways to eliminate or reduce the risk? So this chapter is all about understanding what is risk, what are the ways to eliminate risk, what are the ways to identify the risk, and also and also discuss on a concept called as value at risk, which is part of this chapter. So let's first start with what are the different type of risks faced by an organization. In fact, just give me a minute. Let's first understand what is risk, or let's understand what is return. Return is nothing but possibility of earning money. Possibility of earning money is called as return. How much money can you earn? That is basically called as return. What is risk is the deviation which can happen from the return. How much deviation can happen from the return? If the deviation is on the higher side, it is a problem for the investor or for the company. How much can the deviation be from the return which we are likely to earn? Or you can also say risk is nothing but possibility of losing money. In fact, we could have seen this as part of portfolio management chapter. Return is earning money, risk is possibility of losing money, and the business faces multiple risks. We have learned some of the risks as part of different chapters. One was interest rate risk, that is variation in my cash flow due to changes in interest rate. And how do we cover this? We learned in interest rate risk management chapter. Currency risk, we learned about this in forex chapter. Price risk, that is the deviation in the price, we learned this part of derivatives chapter, how you can hedge it. So there are different risks there. You can also say counterparty risk, default risk, political risk. There are multiple risks which a business is going to face. So in this chapter, first we are learning is what are the different types of risks faced by an organization. Whatever category I said, I can broadly categorize them into four: strategic risk, compliance risk, operational risk, and financial risk. Now, the focus in this chapter will be more on the financial risk side, but let's discuss all the four. What is strategic risk? Strategic risk is every organization prepares a corporate level strategy, a functional level strategy, or a corporate, business, and a functional. The strategy may become ineffective and will not give me the required result. The strategy becomes ineffective and it fails or it struggles to achieve its goal. I am not able to achieve my goal because my strategy has become less effective. And a very good example which ICI material talks about is a new competitor entering the market. Example, Reliance Jio. When Reliance Jio entered into the telecom industry, the strategy of Airtel or your idea was not effective in getting the required result. They were not able to get whatever results they wanted to achieve. They had a goal of becoming maybe a market leader or improve revenues, improve profitability. All those goals, they were finding it difficult to achieve because a new competitor entered the market. Moment the new competitor entered the market, you see a lot of changes happening, and because of these changes, they were finding it difficult to achieve the required result. Second is a compliance risk. What is compliance risk? Is if an organization does not comply with various rules, regulations, acts, then it will lead to trouble for them because it can lead to huge fines, huge penalties, and sometimes even the survival of that can be a question mark. You cannot tell to the government that you are not aware of a rule. Ignorance cannot be taken as an excuse for not complying with rules and regulations. In a company has to comply with Income Tax Act, Companies Act, your GST Act, SEBI regulations. If you have listed, you will have conditions from the BSE, NSE. So many conditions are there. You will have to comply with all of this. What is operational risk? Is internal risk of a company when the processes of a company are not effective. When the processes within a company are not effective, because I have a process of buying raw material, I have a process of inspecting raw material, I have a process of issuing raw material. In this process, if proper controls are not there, the storekeeper may conduct a theft. He may do a theft and it is not even known because your processes are not proper. So this is an operational risk related to people as well as process. And the last category is financial risk. What is financial risk? Is unexpected changes in the market, unexpected changes in the market, which is financial condition. The changes can be in price, which you were covering it through something called as derivative, exchange rate, which you were covering through a forex chapter, interest rate, which you were covering through interest rate, or credit rating of a company changes. So financial risk refers to the unexpected changes, because if prices go up, raw material prices going up, prices going down, FG prices going up, going down, all that is going to impact my performance. RM prices going up, going down is a problem. FG prices going up, going down is a problem. So it can be a challenge for a company when there are changes in the financial condition, because ultimately it's going to impact my performance. What are the various types of financial risk? Our focus will be primarily on financial risk, not the overall risk. Overall, we have 4 categories: strategic risk, compliance risk, operational risk, and financial risk. Now, I gave you certain examples. All these are primarily examples of your financial risk. So, in financial risk, we have counterparty risk. What is counterparty risk? Is I did sale to a customer. Customer is not fulfilling his commitment and not paying me. Or I made an advance payment to a supplier. He is not supplying the raw material. Refers to non-honoring of obligations by the counterparty, delivering the goods for the payment already made, or you delivered the goods but not getting the payment, or default in payment of borrowing or interest. This is also known as credit risk. Political risk. What is political risk? This is normally faced by overseas investors. In the current scheme of things, assume an Indian company has done certain investments in Israel or Palestine, where there's a warlike situation which is going on. So if you made some investment in those two countries, you're going to have huge losses. You're going to have huge losses because there is a risk which is going on. Also, if it's a normal working scenario, no warlike situation, but still the government of that country can say, I am going to confiscate all your property. I am not going to allow you to remit any money outside. Assuming you invested in Sri Lanka, you made profits. They are saying, I am not going to allow you to remit this money back. You will have to use that money only in Sri Lanka. Some borrowings restrictions are there. Restrictions on conversion of local currency or host currency into foreign country. So a lot of restrictions which can be brought in by the government, normally faced by overseas investor. Interest rate risk is basically variation in my cash flow due to changes in interest rates. Interest rates going up or going down can lead to, if I am a borrower, interest rates going up is a problem for me. If I am an investor, interest rates going down is a problem for me. So variation in my cash flow due to changes in interest rate. As I had explained in IRRM chapter, this risk is mostly prevalent for banking company. Predominantly, therefore, banking company, because for them, their balance sheet is primarily, having interest sensitive asset as well as interest sensitive liability. Whatever income they are generating, that income generation is out of the assets which are generating interest and liabilities where interest is getting paid out. So somewhere a combination of that is what is leading to income. Currency risk. Currency risk is normally faced by an importer or an exporter, or if you have a foreign currency investment or a foreign currency borrowing. If you have either of this risk can come. Liquidity risk is same as counterparty risk. Basically what can happen is you have borrowed some money, and you are not able to repay your liabilities. That is technically called as liquidity risk, inability of the company to meet its liabilities whenever they become due, and this will become a counterparty risk for the other party because you are defaulting on your obligation. Okay, let's move to the next question, which is frequently tested exam question. What is financial risk, or how is financial risk viewed from different perspective? That is the financial risk, which is basically the unexpected changes in financial conditions such as prices, exchange rate, credit rating, interest rate. How is it viewed differently by different people? Because there are different stakeholders in a company. Government also looks at, company also. So how is it being looked at by different people? Also what they're saying is, in your categorization, political risk was one of the category of financial risk. We had counterparty, political, interest rate, currency, and liquidity risk. So political risk is as such not exactly a financial risk in direct sense, but any unexpected changes there can lead to huge financial losses. Now, from a stakeholder point of view, stakeholder is basically, you can understand it to be investors' point of view. There are two types of investors, a debt investor and an equity investor. Equity investor is going to look at financial gearing or debt equity ratio to check how is the financial risk of this company, or how risky is my investment, because if gearing, debt equity ratio increases, it is riskier for an equity shareholder. And from a lender point of view, lender is person who's lending money, he is also going to look at this gearing ratio, because if gearing increases, it can lead to problem. Company's point of view, what is company's point of view? From my point of view, if I am giving money to someone who defaults, that can lead to problem. Or if I'm borrowing excessively, if I borrow excessive amount or lend to someone who's going to default, this can ultimately lead to my company going into liquidation. And from a government point of view, we have seen these events happening in US. When a big bank fails, like Lehman Brothers, if there is a failure of a big bank, it can lead to a distress. For example, in India, if ICICI Bank or State Bank of India fails, then that's all, our entire system will collapse. The entire financial system of India will collapse when there is a risk of a big bank or systematically important bank failing. Banks like SBI or ICICI Bank cannot, India government cannot afford a failure of them, or basically they getting wound up. So failure of any bank or downgrading of any financial institution. What is value at risk? Now, value at risk is a concept which you learn in this chapter. Value at risk is basically trying to identify how much is the potential loss I am going to face when the worst case scenario happens. Every organization can have a worst case scenario. So if there is a worst case scenario happening, what is the loss I am going to make? The loss is primarily dependent on standard deviation, because the risk of any security or any asset depends on its standard deviation. So if you have high standard deviation, you have a high value at risk, that is high potential loss. And if you have low standard deviation, you have low value at risk. So it's a measure of risk of investment. It is going to identify what is the worst case scenario and what is the potential loss. So your this value at risk is dependent on standard deviation. It can be calculated for a time period. The time period can be 1 day, 1 week, 1 month, 1 quarter, whatever is the requirement of the organization. And there's a confidence level which is stated. There's a 95% confidence level or a 99% confidence level. You see this in problems. That is, with what confidence am I saying that this is the maximum loss I'm going to face? So somewhere this probability analysis needs to come into picture. Because of this 95% probability that loss will not exceed, or a 99% probability that loss will not exceed this limit. Why are we doing this value at risk? Because value at risk is going to tell how much is the maximum loss I can face. So if I'm aware of my value at risk, then I can decide, or I can afford to suffer a loss of only this much. I cannot have a very high value at risk. So based on that, if I'm a banking company where there are people who are going to buying and selling of foreign currency or buying and selling of some assets, so I can set control limits saying that we should not go beyond this limit. So I can use it to fix the limit for individuals dealing in front office of a treasury department, to decide my trading strategy, to calculate what is the maximum possible loss and use as a benchmark for performance measurement. What are the various hints indicating a counterparty risk and how to manage them? Now, what is counterparty risk? We have already seen. Counterparty risk is basically the risk that on the due date, my counterparty, that is my customer, are non-fulfilling my obligations by my customer or my supplier, or in case you have lent money to someone from a bank point of view. Now, what are the hints which can indicate this? There are multiple hints which can be indicated. That is, you are doing a project, but you do not have the necessary resources to complete the project or the transaction undertaken. There are no necessary resources available. If you do not have adequate resources, what is men, material, machine, money, if you do not have the adequate resources, then there is a counterparty risk which can happen. You are planning to do a project for someone else, or you are going to do some manufacturing for someone else, and the other party fails because you do not have the adequate resources. Government puts in some restriction, or hostile action taken by a foreign government, or the counterparty has become insolvent. What are the techniques to manage this? See, anytime you want to give any credit to a customer, you will have to do a proper due diligence. Without doing a due diligence, you should not provide any credit to a customer. Giving credit to a customer should be done only after doing proper due diligence. If due diligence is not done, what is due diligence? Is checking their financial statements, getting feedback from few people. So after these checks are done by you, you can fix the limit, how much credit you want to give. Know your exposure limit. Review these limits on a continuous basis. We should also not overcommit to a single party. I should not have huge concentration from single customer or from a single supplier, and in case anything has gone wrong, I should take rapid action. And if I can bring in some guarantees, that is an example is an insurance guarantee or a letter of credit instrument. All this, what will do is, if my customer is not making the payment, I have an ECGC cover. So the ECGC cover will give me this amount. Or if I take a letter of credit, the customer's bank will make this payment. So I should go for certain instruments to protect myself from this risk. How to assess political risk and techniques to manage the same. Now, the political risk is something which is being faced by the overseas investor. To make it very clear, it is very difficult. It is very difficult to assess the political risk, because what happens is, this is a very important risk, but it's slightly a subjective way of measuring the risk. So I can try to identify this risk by looking at the actions of the host country government, actions such as insistence of local labor, insistence of currency conversion. If all these insistence are coming in, that is, you want to put up a plant in India, you'll have to use only local labor, local financing. All this, if you try to put in, this indicates that this risk exists. Now, I don't want the government to take a hostile risk or to take certain hostile action. So country risk is basically a subcomponent of political risk, and now you can assess the country risk by looking at the credit rating of a country. There's a sovereign credit rating which is given. So you can look at the credit rating of a country to understand how risky is this country. There are few people or few organizations who will say, I will not invest my money in XYZ country because I believe XYZ country is a risky country. So you have certain risky countries, you have certain non-risky country. You do not want to get into risky countries. So looking at the political ranking, looking at how popular this, because we normally do not want the governments to change on a continuous basis. If the current government continues, it means there is going to be stability, unless there are a lot of issues in the government. When can the issue come? The issue can come if the macroeconomic conditions are bad. What is macroeconomic? GDP growth, inflation rate, unemployment rate, poverty rates. If these are very bad, then this can lead to challenges and there can be a government change which can happen. So you should ensure that government changes not happen in that country. If it's not happening, then there's a stability in that country. How can I manage this? The first two ways is not something which is easy to do. Local sourcing, local financing. Go for local sourcing and local financing. These are the two options you have. Basically, do not enter into any export transaction, just do the local transaction. If you are doing local transaction, all this will not happen. Many a times a foreign company, when they want to invest in India, they will go for a joint venture agreement. They'll go for a joint venture agreement with a local partner, because this person who is in India will have better understanding of what is happening in the country. He will be in a position to understand this risk better and take corrective action as and when needed. Prior negotiations, in case you can do some discussions with the government and understand what is their view. What is the view of the government on all these points? If at all you can get that. How to identify interest rate? I think the next two risks, the interest rate risk and the currency risk. Your financial risk was broadly categorized into five basically. Counterparty risk, political risk. We understood how to assess the counterparty, manage. Political, how to assess, how to manage. The next two, I think we're just going to see how to identify them. Managing them, we have seen in IRRM chapter, interest rate risk management chapter, or forex chapter. Now, how to identify interest rate risk? Interest rate risk is basically, is there going to be changes in the interest rates in a country? If the interest rates in a country changes, it indicates interest rate risk. Now, what are the factors which can change interest rate? Primarily, the factor is inflation. The primary factor which impacts your interest rate is basically inflation. If inflation is increasing or decreasing, that can have significant impact on the interest rates of a country. So monetary policy of the government or the RBI, which will be based on what is happening to the inflation. Inflation is primarily dependent on the economic growth which is there in the country. So if the growth is there, it has some impact on inflation. Growth is not there, it has some impact on inflation. So inflation is the primary factor, monetary policy of the government. Apart from that, other actions like when government introduced demonetization, there was surplus liquidity available with the bank, so interest rates could have gone down at that time. Industrial data, is the economy growing, not growing? If foreign investors are putting in money or not putting in money, how to manage them? We learned this in interest rate risk management chapter, where we have traditional method. We have the newer methods like your interest rate futures, options, swaps. Traditional method, I think, asset and liability management, forward rate agreement. How do you identify currency risk? Again, currency risk is basically the likely variation in the exchange rate. Is there any variation which is going to happen in the exchange rate? We learned in IRPT and purchasing power parity theory, interest rate parity theory and purchasing power parity theory, that exchange rates of a country is dependent on interest rates, of a country. If interest rates go up, exchange rates, or if a country has higher interest rates, high interest rates in a country vis-a-vis another country will lead to depreciation of the currency. Interest rates are dependent on inflation. So the two major factors, interest rate and inflation. Apart from that, government action, RBI action, change of government, demand and supply of the product, natural calamities, all this can have impact. But the primary factor is interest rate parity theory aspect and purchasing power parity theory aspect. So in this chapter, before I discuss question 9, I'll quickly revise it. Question 9 is just to do a summarization. So what we learned is, first we understood what is risk. Risk is nothing but the possibility of losing money. Risks were classified into 4 categories: strategic risk, compliance risk, operational risk, and financial risk. Strategic risk is basically the risk that our strategy will become less effective. Compliance is not complying with rules and regulation. Operational risk is people and process driven risk. Financial risk is changes in financial condition. The financial risk part can be categorized as counterparty risk, that is the default risk of the counterparty. The second element we saw was on your currency risk, where there are changes happening in the exchange rate that impacts the company. Interest rate risk, where there are changes happening in the interest rates which again start impacting the company. What can be the impact on the company because of the changes which are happening? Political risk, which is being faced mostly by overseas investor. And we also saw something called as a liquidity risk, where I do not have the ability to meet my obligation. Liquidity risk of mine is the default risk for the other party. What is financial risk? Financial risk is changes in those financial conditions. Political risk is not directly a financial risk, but still it is part of your financial risk, because any political risk will have huge losses for an organization. There are three ways to look at. One, from a stakeholder point of view, you look at the gearing ratio. Company point of view, if you are borrowing excessively or if you are lending to someone who default. And from a government point of view, there's a failure of an important bank or a downgrading of a very important financial institution. Value at risk is basically, it answers what is the worst case scenario and what is the likely loss we are going to face. There are multiple components of value at risk, which is you have a confidence limit. You look at what time period or how much loss you're going to face. You can use this to calculate the maximum possible loss, to assess your performance, benchmark for performance measurement, fix up the limits, deciding trading strategies. What are the ways which are indicating counterparty risk? If the counterparty has not got the adequate resources, or have become insolvent, or if there is any hostile action taken by the local government or the foreign government. How can I manage the counterparty risk? I do not overcome it. I do my financial due diligence. I set up some credit limit and do a continuous monitoring of that credit limit. How to assess political risk? Political risk is basically the risk that there is some hostile action taken by the government. A political risk can be indicated through multiple ways, that where government is putting, saying that you will have to do only local sourcing, you will have to use only local financing, you are putting certain restrictions on the company. A major component of political risk is country risk, which can be assessed through how is the popularity of the current government, what is the political ranking, what is the credit rating of the country, and how do I manage this, going for local sourcing, local financing, or having a joint venture partner. Interest rate risk is variation in the interest rate. Primary factor is monetary policy of the government or actions taken by the government. Economic growth, inflation, all other aspects. So inflation is part of the monetary policy, economic growth and other factors. And your currency risk is basically like an interest rate parity theory and purchasing power parity theory. Apart from demand and supply, changes of government, natural calamity, all this can impact your risk on currency side. How to manage this risk, we learned that as part of your forex chapter. Last question, risk exposure. It is more like a case study. I'll maybe give a minute or two for you to read this first. Read this and then I'll start explaining. Go through the question. Okay, let's look at this. TRC cables is in the business of manufacturing electrical cables and data cables. Let's first just see what is the requirement. So as you read the para, you will look at from that perspective. Any case study, always better to see what is the first requirement. Even you will be doing some case study related area in other subjects. First see what is the requirement. Then read the case study. Your mind will think accordingly. While mainly it exports the manufactured cable to other country, it has also established its production facility in some African country. This exposes me to political risk because I have my manufacturing facility an Indian company has a manufacturing facility in some other country. So this is going to expose me to a political risk. In African country, due to availability of raw material and cheap labor, some of the major raw materials such as copper, aluminium and other non-ferrous metal are also imported. If you import something, you are going to have currency risk. You're going to have currency risk. Hence, there are frequent receipts and expenditure which are in non-INR. So, I am exposed to political risk. I am exposed to currency risk. So, TRC makes use of long-term debt and equity. Moment you have long-term debt, if you have any debt in your balance sheet, you are also exposing yourself to interest rate risk and equity to meet its long-term. But to finance its operation, it also makes use of short-term financial instruments such as commercial paper, bank credit, term loans from the bank. So there is also the risk which I have, which is on the interest rate side. If any surplus cash is left with, it invests in interest yielding security. Recently, due to stiff competition from its competitor, I've relaxed my policy for granting credit. If you have relaxed your policy for granting credit, that is, if you start giving higher credit, you will also expose yourself to counterparty risk. So we are also exposed to counterparty risk. Also, to hedge ourselves against the various risks, we are entering into over-the-counter derivative product. Over-the-counter means it is not happening in the exchange. When it happens in the exchange, there will not be any default which will be there. But when it's over the counter, when you're dealing between two parties, I explained this, the difference between forwards and futures. Any over the counter product can have something called as a settlement risk or a default risk. Apart from this, copper as a product is very volatile in nature. Copper by nature is a very volatile raw material. So you're also exposed to something called as a price risk. Let's see what they have mentioned. Currency risk, commodity risk are the price risk, interest rate risk, counterparty risk, liquidity risk. Liquidity risk is inability to meet my obligation. Because I'm using commercial paper, I will be exposed to liquidity risk because in case I do not have the funds to make the payment, there's a possibility of a liquidity risk. Political risk is there and settlement risk. This is basically because of the over the counter product derivative. In case you enter into normal derivatives, you will not have this liquidity risk. Clear? If there are doubts, you can message me. Thank you, friends.